Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Jay Conner. Jay is a proven real estate investment leader and is known as the Private Money Authority. Without using his own money or credit, Jay maximizes private money to buy and sell properties with profits averaging $71,000 per deal. And in just a minute, we're going to speak with Jay about how to find and access private money to grow your real estate portfolio. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Jay Conner. Welcome back to CREPN Radio.
Yes, Darren, it's great to be back. I tell you, I must have done an okay job the first time you had me on, and you wouldn't have me back, but it's so good to be here with you. And wow, I'm so glad you're having me here to talk about my favorite subject, private money, in this very interesting market that we're in.
Yeah, I'm looking forward to it in a big way. As you alluded there, the market has changed, and private money is definitely more of an option now than in the recent past where the banks were giving free money. But hey, before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure. Well, my wife, Carol Joy, and I, we live here in eastern North Carolina in a really, really small town called Morehead City, North Carolina, population 8,000 people. Our total target market is only 40,000 people, and we do 2 to 3 single family houses a month. But our average profits now are actually not 71,000, they're 78,000 now as of the last 12 months. So we're not in a big market, but the point is, if you can do 2 to 3 deals a month and average a profit of $78,000 and work in the business less than 10 hours a week, then, those numbers, seem to work out okay. Anyway, I've been full-time in real estate investing since 2003. We've rehabbed over 450 houses here in the local area. And Darren, I know your audience is primarily interested in commercial deals. I'm so glad you had me on here because private money, it's all the same money, whether you're doing a commercial project or you're doing single family houses, it's all the same private money. Of course, the deals are just structured a little bit differently. Well, as I said, I've been full-time since 2003. From 2003 to 2009, I relied on local banks, institutional money, mortgage companies to fund our real estate deals the first 6 years. And then in January of 2009, I had 2 houses under contract to purchase. And I called up my banker. I'd been doing business with my banker for 6 years. And I learned very quickly that my line of credit had been closed. I had no way to fund my deals. And that was with no notice. And I had an 800 credit score. But of course, Darren and your audience, you recall what was going on in 2007, 2008, and 2009. And, for many, many different reasons, we're sort of back into that place again where money is tightening up. So anyway, didn't have a way to fund those deals. Well, my definition of coincidence is God's way of staying anonymous. In less than 2 weeks, I learned about this world of private money and private lending. And I tell you, it was the biggest blessing in disguise that I've ever had in our business. And that is being cut off from the banks. You see, if I hadn't lost my line of credit at the bank, you and I wouldn't even be visiting today. I wouldn't even be here on your show, because it was because of that necessity that I had to find another way to fund my real estate deals. And so I learned about private money, private lending. And, this way of doing business and borrowing is 180 degrees different, the opposite direction, than the traditional way of borrowing money. The traditional way of borrowing money is you go to the banker and you get on your hands and knees and you put your hand underneath your chin and you go, Mr. Banker, Miss Banker, please give me a mortgage. Please loan me money. Please fund my deal. And in this world, it's the opposite. You see, we don't ask anybody for money. I've never asked anybody for money. I got 44 private lenders funding our deals right now. I've never asked them for money. I've never pitched a deal. And they say, Jay, how in the world do you do that? Well, I put on my teacher hat and I teach individuals. We're not talking about institutional money here. I teach individuals, human beings, just like you and me, what private money is, how they can get involved, how they can get high rates of return safely and securely, all backed by real estate. And when they learn our program, they're chasing us. I've got more private money chasing me now than ever before on this side of COVID. So back to the background, I learned about private money. Since 2009, I've never missed out on a deal for not having the funding. In fact, I've got a problem. My problem is I got more money than I know what to do with, right? People don't know what to do with their investment capital or their retirement funds, which they can use one or both to invest in real estate as a private lender. And they don't know what to do with it. As of right now, the average interest rate at a local certificate of deposit for 12 months is still 0.97%. A year ago, it was 0.17%. So it's almost 1% national average. But, I come along and pay so much more than that and give them high rates of return safely and securely. This world of private money puts you in the driver's seat because you make the rules as the borrower, and it fixes your cash flow. I never take any money to the closing table, always bring money home. I mean, you can tell in this market, I'm really excited about private money.
No, I love it. Excuse me. So let me ask this, because I think, your little timeline there of when you got started in 03 to 09, most people remember that was when the world stopped, when the big banks failed, and then Congress and TARP and all these other things that happened, and basically the Great Recession occurred. If you look at those times when prior to that, money was available traditionally to where money wasn't available, and caused you to have to kind of turn. Do you find that the private money does it have a season? Is there a time when it's more in demand? Is it more of a need, or is it more of a matter of it's always there? It's a matter of understanding how to find it, how to recognize it, how to access it.
Yes, it's always there. It's always there. Here's what's interesting. The people that have it, most of them don't even know that this opportunity exists for them to be a lender. You see, again, we're not talking about institutional money. We're talking about doing what I call business with relationship money, right? Doing business with individuals. If you're doing a commercial deal, you may do syndication. You may create a fund and you have individuals invest in that fund to fund your project or your deal. If you're into single family houses, then we do funding what we call one-offs. So a one-off is you have a private lender or a couple of private lenders that are funding a single family house, or it could be a duplex or whatever. So you may have just one or two private lenders that are funding that. But the money is always there. When people, or the time when potential private lenders, individuals really get excited about the opportunity is when the stock market is so volatile. The stock market's always volatile, but particularly when they're starting to see values come down in the stock market. Well, you see in the stock market, it is a security. But what is your security? A piece of paper called a stock certificate. When a private lender is funding real estate, if they're funding a single family house, then they're actually getting a mortgage or a deed of trust like the bank does to protect their interest. So they're just not loaning money out unsecured. They're loaning money out as a private lender, getting the promissory note, getting the mortgage or the deed of trust that collateralizes the promissory note. They're being named on the insurance policy as the mortgagee, just like a bank would be. They're named on the title policy, just as an additional insured, just like the bank would be. So the money is always available for us real estate investors. And and the people that, like all 44 of my private lenders, they never heard of private money. They never heard of private lending. They never heard of self-directed IRAs until I taught them about it. So is the money always available? Yes. Are we as real estate investors always interested in that private money? Well, the answer is yes, because it puts you and keeps you in control of your business. So it's always there. We as real estate investors, if you really want to be in control and in the driver's seat, you want to have a private lending program ready to teach other people how they can get involved safely and securely, earning high rates of return, and have your private money program ready to teach other potential private lenders how that works.
So I get that it's always available, and you mentioned, having some sort of a program where you can teach, investors or not necessarily investors, but potential lenders, the opportunities. What are some reasons that an individual would be interested in lending money to you or I or any other real estate investor?
There's really three big reasons why a potential private lender or individual would be interested in learning about this and doing business with us. First of all, they're going to make a lot of money in comparison to what they can make elsewhere. So, where can an individual invest their money? Well, there's lots of places you can invest, but most people are either going to have their money sitting around, in a money market account earning zero, or they're going to have it in a certificate of deposit at the bank earning, maybe 1%, or they're going to have it invested in the stock market because they don't know any better and they don't know any different. So when you come along and offer an opportunity to first, by the way, I want to make a really, really important point before I finish answering the question on why would they be interested in doing business with us. First of all, unless you have created a fund and you're doing syndication and you're raising money for a project, okay, that's great. But if you are full-time real estate, maybe in single family, maybe in commercial, the best time to raise private money is when you don't need it.
Mm-hmm.
The best time to raise private money is when you don't need it. So I'm all the time teaching people, giving them my 16-minute audio, teaching them about private money. So they're going to make a lot of money. Now, what's the definition of a lot of money? Well, first of all, right now I'm paying 8%. So if I'm going to pay a lender 8%, well, that's, 8 times more than they can get at the local bank right now. And so, particularly these private lenders, the older they get, the more important it is for them to be investing in something that's not volatile, right? So number one, they're going to make good returns. Number two, the second reason they want to do business with us is that their investment with us, their loan to us, it's safe and it's secure. And here's how. Number one, it is safe, and here's how it's safe. We do not borrow more than 75% of the after repaired value of a property. I did not say 75% of the purchase price. I said 75% of the after repaired value. So they've got a 25% equity cushion between what the property is going to be worth when we finish, getting it all ready for market, and what we're borrowing against it. So it's conservative. Secondly, I said it's safe and secure. It is secure because we're not borrowing unsecured funds. Now, can I borrow unsecured funds? Sure. It's legal to borrow unsecured funds. I could just give somebody a promissory note and they loan me money, or, they loan me money from their retirement account if they have moved those funds over to a self-directed IRA. But that's the second reason, safe and secure, right? Backed by the real estate that we're borrowing against. And the third reason I alluded to, their investment and the value of their investment is not volatile, in contrast to the stock market. When someone invests in the stock market, they already lost money. There's fees, there's commissions, etc. Well, in this program of private money, there are no fees, there are no commissions. And here is a rider downer. The principal loan amount that we borrow remains the same until cash out, meaning I'm not paying principal and interest payments. I'm either letting the interest accrue and not making any payments until the property cashes out in sales, and then I pay back the private lender all their principal investment amount along with the accrued interest. You think that'll help you cash flow, right, as the borrower? Or I might be making their payments, and that's fine. I mean, I'm happy either way. I let the private lender decide what's their objective. I've got some elderly private lenders that are relying on the monthly income on their investment with us, and that's okay. So I leave that up to the private lender as to how often they want to get payments, or if they will allow me to just let the interest accrue on the project until we cash out, if they're not relying on that income. So the third reason that they want to do business with us is that the investment and value is not volatile, in contrast to the stock market. So in the stock market, as I said, there's always fees and commissions, and the value of that investment can be less. The principal value of it can be worth less tomorrow than it is today. Well, you see, in this program, nothing comes out of their principal loan amount, their investment with us, and they know exactly what the returns are going to be. So just in recapping, they're going to make a lot of money. Number two, safe and secure. Number three, the investment value is not volatile.
Excuse me. All of that is, and I like the way you make it. It's the simple 1, 2, 3. It makes a lot of sense, and it's easy to remember, and definitely all pertinent. I'm curious, two things. One, on the number two, the 75% of the repaired value. So that's kind of a flip, kind of a flipper, kind of a jargon that I'm familiar with. How in that situation with the market doing what it's doing, are you gauging what that future market value is, given the change in the marketplace with interest rates from institutions and that?
Yeah, that's why we don't borrow more than 75% of the after repaired value. So most of the deals that we're doing are not buy and hold. In fact, today, none of them are. None of them are buy and hold as far as the single family houses go, because the market is changing. Now, here in Eastern North Carolina, I've had no reduction in values. Now, that's not the case. That is not the case in some other areas of the country. Other areas of the country, as of today, are experiencing some pullback in values. But that's why we don't borrow more than 75% of the after repaired value. Typically on the single family houses that we're going to be involved with, we're going to be in those deals somewhere between, depending on how big the rehab is, the renovation. I mean, our average renovations now are around $40,000, but you know, I'm doing another one on Pearson Circle in Newport. That renovation's 175,000, but that's way out of the ordinary, right? So we're going to be in and out of those deals typically within 9 months. You said, well, Jay, if the market's still hot in your area, why would you take 9 months? Well, I've got so many projects going on. I may have a property sitting there for 3 months before we actually start, you know, the renovation. So with that said, since we're typically going to be in and out within the 9-month period, well, when we borrow no more than 75% of the after repaired value, the odds and the chances of values coming down 25% within a 6 or 9 month period is pretty slim to none. So that's why I define this program as a conservative loan to value, since we're only borrowing 75% of the after repaired value.
Got it. You mentioned kind of the source of capital that your lenders have available. Obviously, if somebody has it in a savings account or in in cash, that's one option. But you mentioned the and I can't remember what it is now. It's the is it the
the self-directed IRAs.
Self-directed, yeah.
Mm-hmm.
Talk a little bit about that, if you would, and I guess how one goes from a traditional 401k into a self-directed, and then also are there any kind of limitations for that vehicle for the lender, or ins or outs, or any kind of things that they should be aware of?
Well, this question you've asked me, Darren, is like really, really important. And here's why. Over 50% of my 44 private lenders are using their retirement funds to invest with us. And so why that's so important is, if I didn't know about self-directed IRAs and how that works, by the way, none of my private lenders that are using their retirement funds to invest with us had ever heard of self-directed IRAs until I taught them about self-directed IRAs and introduced them to the company that we actually endorse. So if I didn't know about self-directed IRAs, I would be missing out on over half of the funding that I'm using for our deals. So what in the world is a self-directed IRA? Well, a self-directed IRA is an IRS approved company. It's also known as a third-party custodian that the IRS is approved to where someone can take current, now that's an important word right there, current retirement funds. Now, what's the definition of a current retirement fund? It can be a 401k. It can be a pension. It can be from a previous employer that you still have invested, in their funds, wherever they have their funds invested. You could have pulled those retirement funds out, and you could have those invested in the stock market, right now. But they are dedicated retirement funds that the IRS has approved and that you are not paying taxes on. That, those retirement funds, the lender is either got deferred taxes or tax-free, et cetera. So they're current retirement funds. Now, these retirement funds could also possibly be where an individual is currently working. A lot of people think that if you are with a current employer and you've got retirement funds in the 401k, you can't touch that. Well, that's not necessarily true. Case in point, I have a private lender. His first name is Bruce. And Bruce worked for Fannie Mae for 30 years. This is really funny. I got a private lender that worked for Fannie Mae. That's funny. Anyway, so Bruce, he and I were eating our fried chicken and pork barbecue here in Morehead City for lunch a few years ago. And I was telling him about my private lending program and about self-directed IRAs. He says, well, I'm working with Fannie Mae and I can't touch my retirement funds to do business with you and invest with you until I retire. So I can't do that for 3 years. Well, I said, well, I'll tell you what, Bruce, here's what I recommend. Contact your plan administrator at your company for your retirement funds and ask them if you have the option of moving a percentage of your retirement funds because you've been with them for 27 years. Guess what? They allowed him to move up to 50% of his retirement funds out of the plan with the current employer, Fannie Mae, and go invest those retirement funds anywhere else. So anyway, these retirement funds, whether you're currently employed or previous employed, the IRS allows you to move those funds over to an IRS approved self-directed IRA company. And it normally takes 2 to 4 weeks to move it. And guess what? Where you're going to move it to, that self-directed IRA company actually will do the moving for you. There's no tax effect. There's no penalty effect. You're just moving it to another custodian. Once the account is established and you've moved those, the private lender has moved those retirement funds over, then guess what? Now they can use those retirement funds to invest in real estate. They can go, buy real estate, renovate it, sell it, and there's no limit to the profit that individual can make, either tax deferred or tax free. Now, most people don't want to mess with what we do. They don't want to market for deals, find deals, negotiate deals, renovate deals, whether it's single family or commercial or whatever it is. Most people just want to sit back and be passive. Here's an interesting statistic, Darren. 71% of people that have retirement funds that they're moving over that they've already moved over to a self-directed IRA company want to loan those retirement funds out on real estate, secured by real estate. Over 70%. They want to be passive investors sitting back doing nothing but getting nice returns safely and securely. So these retirement funds that these people use, it's a great way for them to get involved in real estate without having to be, doing the work that we do of finding deals, negotiating, and rehabbing. So here's the actionable item. I said all that to say one thing. As a real estate investor, if you want to not miss out on over half of the funding, and here's what's interesting. Before COVID, there was 18 trillion, that's with a T, before COVID, there was $18 trillion sitting in cash in people's retirement accounts here in the US. On this side of COVID, $31 trillion are sitting in cash in people's retirement accounts because they are scared to death of putting those retirement funds in the stock market because it's so volatile. Well, now you come along and you offer a way and a pathway for them to invest those retirement funds safely and securely. And any of those funds that are Roth IRAs, they can earn unlimited money in returns tax-free. I've got one private lender in just 1 year, because of using the retirement funds, investing with us, earned $65,000 in 1 year tax-free. So yeah, here's the actionable item. If you want to get more funding for your real estate deals, whether it's commercial, single family, here's the writer downer, establish a relationship with a self-directed IRA company to where you can refer and introduce new potential private lenders to that self-directed IRA company, to where your new lender can transfer and move their retirement funds over to them, tax-free, penalty-free, no penalty, and start doing business with you and funding your deals.
Excuse me. That's great. I think the kind of the mechanics you went through there about, you have the 401k, and I think most people are probably led to believe that they can't touch that until they retire. But the fact is that in most cases, I think the employer gets to dictate, when
Oh
they
yeah,
set up the
yeah.
plan and all that kind of stuff.
Some plans may not allow you to pull out any
Right.
until you leave the company or until you retire. That's why they've just got to ask. They just got to contact the plan administrator and ask, does the plan allow me to pull any or percentage out prior to retiring or leaving the company?
Right. And then the other thing, not that this applies in this example, is that, but I think that sometimes people, they get, oh my God, I can move this money over there, and then I can do this and I can do that. I believe there are some arm's length transaction requirements so that you avoid any kind of potential penalties, meaning you can't lend to your children, you can't lend to your parents. There's something like that. But investors like yourself or anybody that's unrelated, investing in one of their deals or lending money in one of their deals is a totally allowable opportunity and a great opportunity. I mean, when you talk about the difference between 1% versus 8%, you talk about the difference of the security of the principal, and assumably you're doing an interest only loan, which is typical for a lot of the like hard money or short term loans kind of thing. The fact that the investor or the lender in this case is going to receive all their principal back and they're going to receive the interest back, they're probably going to say, "Hey Jay, when's the next deal?" When
They never want it back.
yeah, they don't want it back.
They never want it back. They want to keep the money working. So, and that's an important thing. These lenders are relying on you as the professional to keep their funds at work. When I teach someone about how they can move their retirement funds to a self-directed IRA and they move those funds over there, they're not earning any money until you put their money to work. So, I don't want to teach anybody about moving their money over to a self-directed IRA, company, unless I know I'm going to be able to find a deal for them to invest and just not let their money sit over there and, earn nothing.
Right.
But you bring up a good point, Darren. Who can you borrow money from and who can you not borrow money from? Well, it's real easy. It's vertical versus parallel. Vertical versus parallel. Vertical means any vertical relationship you have, you cannot borrow from those people. Well, what do I mean by that? Parents, grandparents, children, grandchildren. You can't borrow from those people as far as retirement funds. Now, liquid capital, you can borrow from anybody you want to. I'm just talking retirement funds. Now, parallel, you can borrow from anybody. You can borrow from brothers, sisters, cousins, uncles, aunts, nephews. I'm talking in retirement funds. Again, if they're just investing with you and loaning you money from investment capital, it doesn't matter. But so we're just talking about that nuance of self-directed IRAs.
Right. No, and I just know that is something to be aware of. Because if you only heard part of this and you thought like, oh, this is great, I'll put the money in the self-directed IRA and then I can lend it to my son or, somebody that is vertical.
Yeah. And you cannot loan it to yourself.
Right.
You can't loan it to yourself. However, why would you loan it to yourself? If you're going to invest in real estate, take the retirement funds and buy the real estate with your retirement account. And all the profits come back into your retirement account. Again, either tax deferred or tax free.
Right. I think the only situation there is as long as you're not borrowing money, then I think there's potential issues there. But if you're buying it in full, at least my understanding is that the profits would roll back into your account and no issues there. So
correct.
So Jay, I think historically, before we would have had this conversation, I think most people would think, well, I don't have any rich uncles, or I don't have, anybody that has just a mattress full of cash, or, something where I could go borrow the money. What I'm hearing you say, and I think this is probably the aha for most people, and you've kind of said it as much, is that anybody with a retirement account is a potential lender if they understand and are looking for a better rate of return in a secure investment like real estate.
Absolutely. Absolutely. You know, people ask me when they're starting out to attract and raise private money. They say, well, Jay, where do I start? Well, you just said it, Darren. Start making your list of people. I mean, they're in your cell phone, they're in your email list, your social media. Who do you go to church with? Who do you go to the Rotary Club with? You know, who do you play poker with on Thursday night? I don't know. But, make your list and start with people that are retired. People that are retired, there's a pretty good chance they got retirement funds, and they're always looking for something safe and secure that gives a high rate of return.
Right. No, that's great. Hey, Jay, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker, and I work with my clients to assess risk and determine what to do with the risk. And as such, there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk. When that's not an option, then we look to see if there's a way we can minimize the risk. And when we cannot avoid nor minimize the risk, we look to see if there's a way we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. It could be their clients, investors, tenants, the interest rates, political, whatever it is that you identify or you consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Jay Conner, what is the biggest risk?
So let me get a little clarification on that, Darren. So are you asking what's the biggest risk from the standpoint of the borrower, a real estate investor, or what's the biggest risk from the standpoint and perspective of the lender, the private lender?
There's no framing of this. It's how you choose to frame it. So,
well,
so blank screen. Yeah.
I'll quickly answer both.
Okay. All right.
So what's the biggest risk for you, the real estate investor, that you're borrowing money? Well, one big risk is you better know what the real value of that property is. How are you determining what the value of the property is? Well, in my case, I've been doing business with the same realtor since 2004. My realtor tells me the after repair value of my property. So you've got to have a firm grip and credible way of establishing what's the value of the property. Number two, what's the risk? You need to know what's the maximum that you should pay for a property all cash. What's the maximum you should pay? I mean, what is your formula, right? So you need to know, and of course I got the formula, what is the maximum you should pay for a property? What's the third risk? Who's on your team? Who is on your team? Like, I sure don't do this business by myself. My team, I mean, I'm like the orchestra director, right? So who's on my team? Well, I can't do this business without my realtor and a relationship there. I for sure can't do this business without my real estate attorney. I mean, my business is at big risk. If I don't have a good real estate attorney, I've been doing business with the same real estate attorney firm since 2003. I get my title searches in 24 business hours. Speed. You can't make money in this business in slow motion, right? So I got to get my information. I got to get my title searches quickly. Thirdly, if I'm in doing rehabs, who's on my team as far as my general contractors? Who's getting the job done? So my biggest risk, your biggest risk is number one, who's on your team? Number two, and the team member is going to give you the value. And number two, you got to have the knowledge on what's the maximum that you should be offering on a property. Those are the risks for you, the real estate investor and borrower. Now let's talk about the risk for the private lenders, right? Number one, the private lender better know what kind of loan to value they're loaning on that property, right? You got a property that's worth $300,000. Well, they better not be loaning $300,000 on that after repaired value. That's why we give them, we're only borrowing 75% of the after repaired value. Number two, what kind of security are they getting? Are they really getting a deed of trust or mortgage that's recorded on public record? I mean, I'm a private lender. I don't care who my relationship is with. I'm not borrowing unsecured funds. I want my funds secured by the mortgage or the deed of trust. Thirdly, as the borrower, I want and I require to be put on the insurance policy as the mortgagee. And guess what? As the lender loaning money out, if there's a claim against that house, I want my name on that insurance check along with the owner of that property. As the mortgagee, I want to have the right to sign off on that check before who I loan the money to gets that check. I want to be named as the lender on the title policy. I want to be protected. And here is my final word on that. And that is, depending on my relationship with the borrower, I may require, as the lender, a personal guarantee. Okay. So, you know, when I loan money out, depending on my relationship with the borrower, I may or may not require them to sign a personal guarantee. Again, that's going to come down to how well do you know that person? And, you know, in this world of private money, I don't care how many safeguards you got in place. There's this thing called trust, T-R-U-S-T, between the borrower and between the lender. And so that level of trust is going to determine as to whether I require a personal guarantee on that note or not.
No, definitely a well thought out, risk avoidance program there. I appreciate that. Hey, Jay, where can the listeners go if they would like to learn more or connect with you?
Absolutely, Darren. Thank you for allowing me to share. I tell you, I am so excited about the recent private money guide, the private money guide that I have written, and you can download it for free. The name of the private money guide is 7 Reasons Why Private Money Will Skyrocket Your Real Estate Business and Help You Build Incredible Wealth. The private money guide is absolutely free. Download it at www.jayconner.com/money guide. Again, I'm an ER, not an OR. So that's www.jayconner.com/money guide to get on the fast track to getting all the private money you need for your real estate deals.
Awesome. Jay, I cannot say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Thank you so much, Darren. God bless you.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.